Hey guys, welcome to Trading the Charts. My name is Rex, and in today's video, I'll be going over 3 things you need to know before buying stock options. Hopefully you guys already know what stock options are, but if you don't, here's the definition. A stock option gives an investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. There are 2 types of options: puts, which is a bet that the stock will fall, or calls, which is a bet that the stock will rise. Now, with that out of the way, let's get into the 3 things that you need to know before buying an option. But first, I just want to preface this with this. By following and understanding these 3 concepts, it should help you become a better options trader. These 3 concepts have personally helped me gain a good amount of success trading options. Number 1, and probably most important, knowing your expiration dates. I'm going to categorize expiration into 2 categories: short versus long-term expiration dates. Options with short-dated expirations are more risky. For one, there is less time for the stock price to move in your favor. And 2, the option can lose value very quickly if the price moves against you, thus making it that much more difficult for you to turn a profit given the shortened time frame. Some common short-dated options are known as weeklies. By definition, weekly options are similar to monthly options, except they expire every Friday instead of the 3rd Friday of each month. Weekly options have come to be popularly known as lotto plays. They are also known as a lottery ticket because of the similarities to a lottery ticket with respect to the odds of winning on these options trades. These weekly options usually have a high probability of expiring worthless, hence the term lotto. In my opinion, these lotto plays are most suitable for gamblers with high risk tolerance. So, who should buy weekly options? In my opinion, it's only recommended for investors who have a high conviction that the underlying stock will move in their favor by expiration. But you should always keep in mind, these weekly options are inexpensive because they are like playing the lottery. There is a high probability the option will expire worthless. So why do people even bother trading these short-term weekly options? Once again, it's like playing the lottery. There is a huge reward for these options when the underlying stock moves in your favor. Also, like playing the lottery is that it is low risk in terms of cost, because a weekly option could only cost you $20 for one contract if, for example, one contract is worth 20 cents. To calculate the total cost of buying one option, you multiply the premium per contract times 100, which is the number of shares per contract, then multiply that by the number of contracts. But as with any other investment, you should always follow this golden rule. You should only risk the amount of money that you are comfortable with losing. Now, another key factor that you need to understand when trading short-term options is theta. What is theta? Theta is the option's Greek denomination for the change in price due to time decay. In other words, the change in price of the option is highly correlated to time decay as the option nears expiration. This means if the option is still out of the money as the option nears expiration, the price will dramatically fall. This is why weekly options usually have high theta. Due to the limited time till expiration, theta will eat at the value of your option fairly quickly as each day passes as it nears expiration, thus requiring the price of the underlying stock of the option to move in your favor rapidly. For more details on the Greek denominations in the options, I highly recommend you checking out the article by Investopedia. Now, as you know, just a couple months ago, GameStop had an astronomical move to the upside. It rose from just $30 to over $400 at its peak. So you can only imagine what weekly call options on GameStop looked like. I want to go over this GameStop example to show you what a successful weekly call option bet looks like. In this example, I will use fictional numbers, so in no way, shape, or form will these numbers be accurate to the actual numbers. But it will give you an idea of what a successful weekly options bet payout would look like. For this example, let's say it's Monday, February 8th, 2021, and GME's current price is $40. Let's say you did your homework and research and found out that GME has a high short interest. News headlines are coming out saying that GameStop will go bankrupt, but you think otherwise. You have a high conviction that GameStop will have a huge short squeeze within the next couple days. You proceed to buy a weekly call option with strike price of $300 expiring February 12, 2021 at a cost of 10 cents per contract. So for simplicity, let's say you just bought one contract. The total cost would come out to just $10. Fast forward 2 days later, Wednesday, February 10, 2021, and GameStop price is now currently $350. Your prediction was right, and GameStop experienced a huge short squeeze. You proceed to sell your call option at a current price of now $100 per contract. So if you calculate that, $100 times 100 shares times one contract, and you've received $10,000 in proceeds. You gained 1,000% on your initial $10 investment. So hopefully this example can show you the huge risk and huge reward that you could receive from playing weekly options. It is a huge risk in the sense that the underlying stock has a high probability of not moving in the money before expiration. It is a low risk in the sense that you only risked $10 to gain $10,000. Now, let's talk about long expiration options. In my opinion, longer dated expiration options are less risky. This is because they allow more time for the underlying stock price to move in your favor. Theta's impact, or the time decay, on the value of the option is lower, given the ample amount of time the underlying security has to move in your favor until expiration. However, you should be wary that theta will steadily increase as the option moves closer to expiration. So, who should buy these longer dated options? I personally would recommend these for the more rational investor. Also, if you're an investor with low risk tolerance, these longer dated options would be more suitable for you. But I want to stress the significance of the low theta on long-term options. Theta is working in your favor, giving you ample amount of time for the underlying stock to move in your favor. Even if the stock initially moves against you, due to the longer dated expiration, there is still a good chance for the stock to eventually move in your favor. But of course, low theta comes at a cost. Long-term options will generally cost more than your weekly options. One last thing to note is, of course, if the underlying stock moves against you, the option value will drop, but not as significantly as it would if it were a shorter dated options contract. I personally have been investing in options for several years now, and only until recently learned that longer dated options are better suited towards my investment and trading style. So it may just be a trial and error process where you should dabble into short and long-term options until you find what's most suitable to your trading and investment style. This is just my opinion and not financial advice. Please always do your own due diligence and research prior to making any financial decisions. The second thing you need to know about before buying stock options is volatility. Volatility is one of the major components that go into the value of the option. High volatility in a stock will bump up the premiums of its options. For example, Tesla's high volatility in stock price and nature could cost you up to $100 per contract in options. So if you were wondering why Tesla options were so dang expensive, That's one of the major reasons why. To dumb it down for you, the high volatility of a stock means that the price can rise or fall a considerable amount, which means a high probability of it moving in the money for your call or put option. When an option is in the money, it refers to an option that has intrinsic value. For example, an in-the-money call option means the option holder has the opportunity to buy the underlying stock below its current market price. When it comes to volatility, you should always be aware of any potential upcoming news and/or events. These news or events can be catalysts for a big move in the stock price. Usually, this anticipated volatility will already be priced into the option. For example, if there is an earnings release date during the life of the options contract, you will most likely be paying a premium for that option. However, once this earnings event passes, what usually occurs afterwards is a huge drop in implied volatility of the option, which drops the value of the option quite substantially. This sudden drop in implied volatility is known as volatility crush. Since volatility is a major component of the value of an option, this is why after a volatility crush, the value of an option can plummet. So this is something you definitely need to keep into consideration when trading options around news or events. The third thing you need to know before trading stock options is that you should always plan your trades ahead of time. You should always have a plan set in place for what price point you are looking to enter a trade. Not only should you plan your entries, but most importantly, you should always plan your exit strategy as well. So why should you plan? Having a plan in place keeps you disciplined. It will help you keep your emotions of the stock market in check. It will also help you be a better trader in general by controlling your emotions of greed and fear and prevent you from acting on these emotions as well. The psychology behind the emotions of a trader play a huge part in determining whether you are a good investor or not. So, how do you plan your trades? Study the charts and technical analysis. I know there are a lot of technical analysis skeptics out there, but I'm proud to say that from my own personal experience, technical analysis has helped me develop an exceptional win-to-loss ratio. Technical analysis uses the stock price history to help forecast where the price may go in terms of probability. It is not predicting the future, but instead gives you an idea of the probability of a stock moving up or down. Technical analysis will help you identify good risk to reward price levels for entry if you're buying or to exit if you're selling. Like with volatility, you should pay attention to news or upcoming events that could be a catalyst either to the upside or down. This will help you understand options pricing, because as I talked about earlier, the higher the volatility, the higher the premiums will be for the options. By understanding this, you will be able to determine whether or not an option is worth buying or not. And lastly, it will prepare you for identifying good buying and selling opportunities. I'll give you an example. Let's say the call option you own has gone up in value already and there is an earnings release coming up. You are unsure of what the earnings results will be and do not want to gamble on the possibility of losing all your gains. But you also know that implied volatility is at a high since the stock is projected to move 10 to 20% and therefore the option premium is trading near its highs as well. You also know that after earnings day, the option price will likely drop due to a volatility crush, so you decide to sell and take your gains ahead of earnings day. I'm going to wrap up the video here, but to summarize, the 3 things you need to know before buying stock options are: number 1, expiration dates. Know the difference between short and long-term options. Number 2, volatility. Know how volatility impacts options premiums. And number 3, plan your trades ahead of time. Have a set plan for what price levels you want to buy and sell at. So I hope you guys found this video informative and hopefully it answered some of your questions about options. And by the way, if you guys want to support the channel and get a free stock worth up to $221.50, be sure to use my referral link in the description below to sign up for Robinhood. Thanks for watching, guys. Please hit that thumbs up if you enjoyed the video and subscribe for more content.